Your credit score doesn't matter anymore. There's a new system being introduced that actually makes a lot of sense, and it's going to allow for loosened credit requirements and open up these loans to a broader range of people. So, even though this change sounds good and what they're implementing actually does seem like a good idea, there are analysts and experts that are worried that it comes at a time where housing prices are sky high, interest rates are extremely high, and we're on the verge of what could be a real estate crash. And opening up that world of loans to a lot of inexperienced people with new formed credit is a recipe that could lead to disaster. We all know your credit score is what gives you your line to loans. It gives you if you're going to qualify for a loan. And when you make the biggest purchases in your life, buying a house or buying a car, that comes down to your credit, and you're going to want good credit to be able to make those purchases. But the system is getting overhauled. It's being introduced with new factors to check on people's credit worthiness and open up the line to a lot more people, which is overall a good thing. But even Congress themselves pushing for this overhaul to happen and allowing people to get a loan without the traditional credit score system that has been used for many, many years now. Which also brings up the question, are the big banks doing this to push out more loans to make more money and raise their bottom line? As a lot of people, millions of Americans, don't have a credit score, don't know what a credit score really is, and it'll give them the opportunity to get loans, which will give the banks an opportunity to make more money. But doing this during a time where interest rates for a mortgage is above 7%, and that's typically the largest purchase that anyone's going to make in their entire life, that could set up people for big failure. Just imagine if you go out to buy a house, you pay $300,000 for a house, have that mortgage, and a year later the market falls and now your house is worth 20% less. You could be underwater on that mortgage, and it puts you at such a big disadvantage overall, and you might not be able to really recover from that. And the recession that we're in looming to get even worse, it could add up to a lot of factors where people lose their houses, go into foreclosure, and then that bankruptcy is still going to affect you, and not something that people really want to deal with. And opening up the doors to such a broad range of new borrowers could be a problem. I mean, right now your credit score is based on a bunch of different metrics coming together to get that score, and it breaks down like this, with 35% being your payment history, showing if you are responsible with paying back your bills, paying on time, and that is a big factor, and obviously it's the biggest weight in a credit score. Then you have 30% as the utilization rate, meaning how much credit you actually use compared to what you have. So if you have $1,000 in credit, but you only use $100, you're using 10%, which is amazing. Ideally, you want to keep it below 30% of whatever your credit limit is. And 15% of it is made up of your average age of your credit. So how long you've had accounts open, how many accounts you've had in good standing, which obviously the more accounts you have in good standing, the better of a borrower you probably are. And 10% is the type of credit you have or types of loans that you have when you're dealing with credit cards, mortgages, auto loans, a lot of those. If you're dealing with all those kinds of different payments and loans, it shows to the borrower that you're more responsible and you have experience dealing with these types of loans. And finally, if 10% is your credit increase every time you reach out for a new credit card or even a mortgage or car loan, you get a hard increase into your report. The more you have, the more risky you appear because you keep reaching out for money. So you want to keep those down to appear more responsible. And obviously, all of these combined come to what your FICO score is now and determines how risky of a borrower you are, and could even determine if anyone even looks at you to give you a loan. Even though all these factors in a FICO score have been industry standard and have led the industry for many, many years now, there is a new system coming up called FICO 10T and the Vantage score. Because lenders even now notice that the system we have in place now limits the types of borrowers. It excludes potential good borrowers from being able to get loans. So for banks themselves, they'll be able to look at things like your account history balance, if you've ever overdrafted, and make more decisions off of giving you credit off of that instead of a credit score, which you might not even have built up. Like millions of Americans don't have a credit score. And this alone will give 72,000 households per year access to credit, which is overall a good thing in expanding people being able to get credit. And it does make sense to judge responsibility that way. If someone's never overdrafted and kept a high account balance, they're probably not a risky borrower, and you don't have to look at them as risky, even if they don't have a credit score. And even government housing agencies are now starting to put in these FICO 10T and Vantage scores to look at other ways to judge people off responsibility and seeing if they're good at paying bills. Because this is going to allow for things like your cell phone bill, your utility bills, and even your rental payments to count towards looking responsible and towards this credit system, so that so lenders can look out and judge whether or not you're a good candidate. If you're paying all your bills on time, chances are you're going to pay your mortgage on time too. And even though I think this is a great change and is something that should be going forward, because if you're responsible with your bills, you should probably be responsible enough to pay a mortgage and get that opportunity at least. But it comes at a time where there's a lot of risk in the market. And if somebody moves from renting to owning into a mortgage and the market falls, that's going to affect the person owning much, much more than the person renting. And it could potentially cause a huge financial problem for someone moving from renting to owning. If the market falls and you're underwater on your mortgage, that is something that some people might not be able to recover from. I mean, even just looking at the Zillow Home Index for prices, we can see that prices are starting to fall. They're starting to go negative, and things are starting to actually not look so hot in the market. And the last thing you want is to be a new homeowner in a market that sends you underwater on your mortgage. Because even if rates were to fall, you wouldn't even be able to take advantage of that if you're underwater, unless you can make up the difference for your mortgage and your loan. Otherwise, you're stuck with the 8% interest rates and whatever payment you have going on. So even though this system is a good idea, and I think it's overall a good step in the right direction, it could end up being, in the short term, harmful, but I think in the long term, it's going to be beneficial and bring a lot more people into the world of credit worthiness and the ability to get loans. That's going to do it for this video. As always, remember to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next